Welcome to this video, and in this very session of the course we are going to be talking on the topic entry, stop loss, target placement using pure support and resistance zone. So basically there is no trading without these things, and there is no any topic or any course you might have come across on the strategy that doesn't talk about these three things is incomplete, because without trade management, all the strategy that we're trying to demonstrate is useless, right? Support and resistance from the core of price action trading, however, precision in execution, when to enter, when to place stop loss, how to define realistic target, determine consistency. Advanced traders no longer guess, they use structure, reaction, and liquidity logic to define clear trade boundaries based on support and resistance. So entry strategy around support and resistance. The entry should align with market context. Rejection entry, wait for clear rejection at the level. Example, long wick at support or upper wick at resistance. This confirms a valid reaction. Retest entry, structure shift. Combine the lower time frame structure break. Higher high, higher low. So this is basically how to take your entry. I will use this uptrend or whatever case. Let's say this is a structure, right? That is uptrend. I position my trend line at the candle body. So this is how the price has been. This is structure right here. Higher low, higher high, higher low, higher high, higher low, higher high, higher low. So this key level support or demand zone, anyhow you may choose to call it demand. This is supply level, supply, demand. So these levels I have marked out is the possible entry zone, right? Sellers target demand zone, while buyers target, sellers target supply, while buyers target demand or support zone. So what should you do when the price gets to this point? I make mention of a rejection. If you notice at the close of this key level, there is always a weak rejection, right? In this case, this is a weak. This is a weak, which signifies price rejection, meaning buyers will try to push more harder to take the price up, but they lack the required a volume or momentum to do that. All of a sudden, price rejects, still return back and close within the channel, which sellers took over to push the price downward, though the overall trend is buy. Same thing applicable here, they are weeks. So when you are targeting these levels to take a trade, this is what you should watch out for first. Rejection. The moment price rejects at the key level, that should tell you that that level is valid. So all what you need to do next is to wait for a confirmation, right? So in the case of a breakout, like in this case, you can see clearly. I don't consider this a breakout. This is what the illustration we just did. This is a fake, breakout at this point. It wasn't valid. The structure did not align at all with the prevent with the uptrend. This is where the valid breakout took place. Another case is that in the case of a breakout, this one that I just demonstrate is those that want to trade within this channel, those buy and sell structure forming. This is other execution from different institutions or bodies that constitute the financial market. I think I did the illustration, I expressed that earlier. So in the case of a breakout, we signify a change, in direction. We all know that, right? So this is a breakout. Then the price drop down, looking for a support level, right? At this point to test, then return back to fill this imbalance. So the price has made upward movement, creates a neckline or a swing high, return back to form a double bottom, though sellers lack the liquidity to push the price downward to align at equal level with this face, bottom, then return back to retest the trend line. So this is a valid point for you to take your trade after a confirmation. So you don't just jump into the trade after the breakout. So illustration on a downtrend. This is what happened. So the price has changed direction to a downtrend. The price came breakout, right? Look for a possible resistance. This is a scenario of a downtrend. So this change of direction. So the moment price broke out, you look for possible or close by resistance to test. So from the breakout region, price has left imbalance. So most time, depend on the structure, price can return back and only test this region if the breakout was very sharp, right? If volume volume that lead to the breakout was strong, sometimes price is not going to come out, come back to test a trend line in this case. This breakout volume was not really strong, but it is enough to confirm that this is a valid breakout. So I'm just letting you guys know that sometimes price can return to test to retest and just stop at this level that the price broke out of the trend line. And scenario like that is always if this candle was very strong, right? If the breakout volume of candle that led to the breakout was strong, price may not likely return to find the trend line again to retest. It will just stop at this liquidity or the imbalance level, fill the imbalance and return back. So after that, price return back. So what you have to do is wait for a breakout. Don't rush to take your entry as the price broke out of the structure, right? Allow it do its things. That is what differentiates professional traders, advanced traders with the younger ones. The new traders is going to jump in the moment they see the breakout, but experienced traders is going to feel relaxed to monitor what institutions are going to do in the market. So price find close by resistance, then retest. As the price retests this zone, you have to wait for a confirmation candle. It depends on what is going to form. It might be bearish engulf. It might be is it a hammer or angry man? It might be is it evening or morning star depending on the direction. So that is what you are going to look at this point. Once you have the confirmation of one of the buy confirmation candle, you then take their entry. And when you take their entry, don't be greedy. I've basically described the whole lecture note at once in this very demonstration. So when taking trade, you wait for a confirmation Without a confirmation, please don't enter the trade. Look at what just took place here. This is recent events, in the market, right? After the sell candle, very strong. You see what happened at this point? This is a structure break, how it's supposed to be. This is structure breaking of the recent low. The candle that led to it was strong. It broke, but look at what happened. This is a rejection. So, situation like this, how are you going to position yourself in this case? You can't just assume that it's going to break out. So price can form double bottom and return back upward. So what are you going to do? What is happening here? You can see sellers are losing momentum in this case. We have seen the rejection candle, we have seen the buy candle, but this candle doesn't really stand for. Okay, you may confirm bearish candle, then a doji, or what is the opposite of pin bar? I know of, okay, this can be bullish, pin bar. I don't know what the three candle constitute. If they stand for anything, then possibly this trade is going to buy up. So this place is going to form the second bottom to push the price upward. But for now, I'm trading, I'm taking this course right now in a very odd market closing basically. But what I'm trying to say is that always wait for situation like this to happen, because if you assume that the price is going to reverse to go up at this point, you can't take entry yet. If you're taking entry, what stop loss pips are you going to use that this movement will not kick you out? It's not possible. Plenty people are out at this point. So what I'm trying to say is that when the price return, wait for manipulation to happen at this point. Breaking out retest is not automatic entry, right? Because like I always say, nothing is certain in the market. These people can decide to still continue this movement downward. That is it. That is how the market works. Nothing is certain. You should always expect any scenario to align your trade and then seek for a confirmation. So as the price gets there, wait for manipulation that is going to take place in this place. Either stop loss hunting, or in some cases a liquidity hunt may not take place basically. So what you should do is look for confirmation candle at this point. If you can't find the confirmation candle that you're familiar with, it is better to leave the market because you can't tell what is going to happen next. But if you see a confirmation at this point, that is when you should not take your buy entry. At the close of the confirmation candle depend on the time frame. And when you're taking your buy entry, make sure your stop loss is below this zone. Make sure it is not too tight so that the market will not kick you out with liquidity hunts, like in this case, and return back assuming it has happened and want to happen again. So give a little bit gap. So that is your stop loss. This your entry basically. How do you place your take profit? So the retail traders with no valid trading plan or trade management may target 100 pips straight. You target this as if you're the owner of the market or you control the market. This is wrong. Or you might not be wrong, but this is greedy. If you want to go that way, find there's always a two-way to everything. But the first thing is that this is your valid entry, valid take profit at this point, right? The price broke out, target this resistance, bounce, retest, and you want to buy at this point. This is enough TP, enough pips to take out of the market. This is basically above 2 1:2 risk to reward ratio. that has taken me to next point still in the lecture material, which I illustrated risk to reward ratio to target. So I'm combining everything to demonstrate at once without really checking the material fine. So this is 2:1:2 risk to reward ratio by estimate 1:2. 1:2 risk to reward ratio. What does this entail? This is the least risk to reward ratio you can trade in all your trading position. If you go below this, then you are not going to have healthy trading account. So let me talk on this before we turn back to demonstrate that long TP placement. So this, though I've said it in my previous courses, for those that hasn't taken any of my previous courses, I will still do the explanation here briefly. So this simply means whatsoever your target as your stop loss, you should always target at least 2 times of that number of pips as your take profit. Meaning, if your stop loss is 30 pips, like in my case, I trade 30 pips stop loss, then your TP should be least 60 pips, 2 times the size of your stop loss. There are some traders that may go, mostly those that trade a smart money concept. I've seen 1:15. Yes, but for myself, the maximum I've gone before is 1:5. Is the maximum I've gone. Basically, I stay with 1:2. Now, why is this risk to reward ratio 1:2 is the least that you cannot go below? Is that it's going to give you an edge, assuming you are everyday trader. You trade on Monday, you trade on Tuesday, you trade on Wednesday, you trade on Thursday, and then you trade on a Friday, market close. Then out of these days, you were not able to secure a parallel win. So on a Monday, you hit your stop loss and you incur minus 30 pips stop loss. On a Tuesday, you were able to win and you secure your trade hit full TP 60 pips. Wednesday, you lost 30 pips. Wednesday, you lost 30 pips. Thursday, you lost again. With this illustration, you lost again 30 pips. Then on Friday, you were able to win again plus 60 pips, right? So you discover that using this risk to reward ratio will help you. At the end of the trading week, your total stop loss number of pips hit is 90. That is 30 multiplied by 3 days, which will have a poor trade run. That's 90 pips. And total number of take profit hits is equal to the 2 days which you had a winning trade, which is 60 pips multiplied by 2, and that is going to give you 120 pips. So at the end of the day, you discover that if you minus your risk to, your stop loss, let's say if you minus your stop loss hits from, sorry, if you minus your take profit hit 120 pips minus 60 pips, 90 pips, you realize that your account is still going to be on the increase of 30 positive pips at the end of the trading week, right? So this is an added advantage and increase to your account. But if you're staying below this 1:1, I've not really seen one is to one on currency pairs, but I've seen one is to one on indices and virtual those virtual trading assets that some traders trade. So, but for currency, if it's still one is to one, you will realize that if you have this kind of experience, of course, one is to one means 30 pips stop loss, 30 pips in take profit. You realize that if this was your case, and these places we had 60 pips will turn to 30, 30 pips as well, and you had two 2 days wait, you discover that your account is going to be on a minus because total number of stop loss pips you're going to incur is 90 and the take profit is only 60. So that takes me to another point, mostly for new traders. I was a victim of this. New traders have the patience to hold a bad trade with the hope that it's going to return very soon. They keep on adjusting their stop loss. But when the trade move, leave entry and go in their reward, they will get scared and close the trade within a short time. This is wrong. Train your emotion to be inverse. If it is possible for you to lose patience holding bad trade, it is good because the earlier you leave, the more easier to recover the loss. There's some loss that you accept in your trading account. Even next 3 winning days cannot cover the loss. That is bad trading. So what does that entail? Make sure you stick to your risk to reward. Meaning if you are targeting a 40 pips take profit, 20 pips stop loss, always make sure the day trade go in your favor. You hold yourself, have the patience to get the full TP so that you can balance off your account properly. There's nothing wrong as you trade move, you move this to take to break even, to be risk free. Okay, so that is that. I will touch a bit on this again while I'm talking on proper risk management and trade placement. I think I will do something on that again. Then this remind me the long target placement. So I say this is the best place for you to position your TP because if I take this structure outside, this is what is happening. Price scale, broke out, this is the breakout leg. Find the breakout region which turn to support. Test it. Return on coming back and you have taken entry here, assuming. This is your best bet to take to place your take profit, which is here. Why? Because price can come to this level. Don't forget, this is a new resistance zone. Price can come to this level. It's not even a new, in this case, this was a key level. This is a key level. Price can come, match up the face top, form double top, and return back downward. And if this happen, I'm not sure you have ability to beat anybody, in the market. You cannot do anybody anything. You're going to lose your money. So that's why it is always advisable target take profit that is achievable. Some take profit is not achievable. The moment you see somebody ignore all these principles, key level placement and the rest to place take profit in the sky. Take profit that with currency pairs, even in the next 5 days, you can't achieve this. This is wrong. Or fine, if this was the overall trend, just in this case that we have demonstrated, right? Okay, let me use a real-time chart in this case. This is the resistance, and assuming we have seen a clear confirmation to buy this trade from these points, and we have taken entry after the manipulation might have took place, just as we have seen the long wick, and we want to go buy at this point, right? then you take that take profit. You have seen your analysis have shown you that the price is returning back to test the resistance. So our stop loss at this point, depending on the time frame, I might not likely place it up to the rejection zone. But sometimes price can still return back to retest this week before, so you can stay below it if it is not too low. But there are some stop loss hunting that is very low. You can't cover all those. So this so you can split this into multiple position. I'm not supposed to, okay, I will do this, then when I go to risk management, I'm going to repeat in a more expanded way and bring out the formula for you to use. So let's assume you wanted to trade Euro USD. In this case, we're on Euro USD chart. You want Euro USD buy, and you want to risk a total of 0.70 loss size, right? So you now decide, because your take profit placement is very low, right? You don't know in case there is hold up on the road, any economic events can drop, or this is key levels, price can just respect any of them return back. So what you have to do is to split this trade into multiple take profit placement, and this is the last point. So in this case, three position. I'm going to split this loss size. Instead of opening 0.70 times 3, that may not be favorable depending on the account equity that you have, but the proper way is splitting this stop loss. This is what you usually risk per position, and I want to do multiple position. So I'm going to start at this point. I will open the first position, Euro USD. I allocate. This one is going to hit early, right? So I'm going to give this a more bigger loss size. So I'm going to allocate 0.30, right? 0.30 loss size to this take profits. So we are left with basically 0.40 loss size. Then at this point, I'm going to allocate 0.25 loss size. So I give more bigger loss size to those positions that will hit early. Then the last one, now allocate 0.15. If I'm correct, the sum total of all these loss size is supposed to give you 0.70. Let me see if I'm right. 0.15, 0.25, 0.30. Ah, wait, I'm wrong. Yes, it's correct. So this is how to trade this. So that you don't lose everything at the end of the day if there is unexpected market reaction. So while the price moves to this point, you have secured profit with this. Then, if you know what you're doing, your stop loss by now should be at entry for this position and this position, because this one is out. So once this one hits as well, that is the second position, or you can call it TP2, your stop loss should leave this place to the TP1 position while you're waiting for the last position to hit. So as the price move from this point upward, you can as well keep adjusting your stop loss price above to secure or book partial profit gradually. Another method is, let's say you open this trade with just one position. I don't know if there is a broker that doesn't accept partial close, partial profit close, or partial stop loss close, but I'm going to recommend a broker in this course. I'll give you a link, some of the best brokers that we have. Another method is opening this Euro USD with your normal 0.70 lot size, one position. Then as the trade move in profit, you do a partial close. Trade can be running and you decide to close profit for 0.10 lot size. That means the active one is 0.60. As the price move, you keep on closing the trade like that if you don't want to open multiple positions. So this is the second case scenario. So that basically takes us to the end of this lecture. I'm sure I have taught everything that I'm supposed to. This is something that we practice every day. So I can't be reading this from the notes, right? Is risk management is basic, one of the things you should have close to yourself if you want to succeed in trading. So some of the common mistakes traders or retail traders usually make: entering trade before confirmation, setting stop loss too tight within liquidity zone, using unrealistic target without structural basis, ignoring risk to reward, and over leverage. I have taught everything, and those are the things you should note at. So the common mistakes should be the solution, and I've said the solution to every of these mistakes, and that is what this course, this topic is all about. So I'm sure you can take personal research to confirm some of the things I've said before you now go into the market to carry out your trading. So in summary, trading pure support and resistance require precision and principle. The key lies in entering on confirmation, placing stop loss beyond liquidity zones, setting logical target using structure, right? I did that. Maintaining a solid risk to reward balance. I have illustrated all those. Then mastering this principle transforms support and resistance from simple chart drawing into a complete provisional trading framework. See you guys in the next topic. Thank you.